after a heady kind of political discussion, it is our responsibility now to take our audiences to something that Mumbai stands for, which is capital markets and business. And I'm going to just not spend too much time on giving a backdrop of what is happening. You all know that stock markets currently, we are at a in terms of market value, we are at a very teasy height. And there is a lot of froth in the market, is what most of the experts are talking about. We will just straight away begin by asking our guests today, what exactly is going on in the markets? Can you just explain to our audiences, is it the right time for anybody to get started, or you have to just wait and watch what happens in the market? Devina first.
Hi, so am I audible? Is the mic working? Yeah. Okay. So, Raja said that there's froth in the market. I would like to temper it by saying there are pockets in the market where there is froth. So if you look at the mainstream, large cap, those kind of stocks, those kind of indices also, I do not think we are at particularly, worrisome levels. They're not that there cannot be interim corrections. And I'm a very data-driven person, so if you look at the data, let us say from the time the Sensex started, which was 40 plus years ago, equity markets have compounded at about 15%, give or take. And so that's what's in our mind, that equity markets give that kind of compounding. But if you look at how volatile those returns are, we know that equity markets are volatile, but they're volatile not just on a 1 or 2 year basis, they're whole decades which are very different. And 2010 to 20 was a decade where you got very suboptimal returns. If you had put in 100 rupees at the beginning of the decade, in 10 years, that 100 rupees would have become 230 rupees, barely more than what you would have made in a fixed deposit. And contrast that with, let's say, 1980, if you had put in 100 rupees in 10 years, it would have become 700. So that underperformance for a whole decade is what created the room for the market to go up. So while in the last 4 years or so, the market has gone up handsomely, it is still not at levels where it is way above the trend line. In fact, it's not even at the trend line. So that's one part. But there are areas of the market where there is froth. So a lot of the stocks that you hear about, very small cap, micro cap, certain industries, IPO market, those are the areas where you need to be careful. And I always tell people say, what's the easy way to find out where there is froth in the market? And I said, the easiest rule of thumb is that the areas where you see a lot of thematic funds, thematic schemes being launched, new fund offerings coming, that is typically when that theme is topping out. So that's a good rule of thumb to follow, because most thematic funds are launched when that theme is close to the highs. If you go back to, let's say, 2021, a lot of NASDAQ ETFs were launched in India, ETS fund of funds, and then the NASDAQ went down 40%. So be careful wherever, whether it is small cap or whether it is this. Sometime back, there were a lot of these defense and PSU and power and those kind of funds. So be careful in those areas. So if you've made money, book the profits and put it in a steadier portfolio. However, I'm still not advising that you sit in cash. Simply because there's a cost to sitting in cash, you might miss out on an up move. I mean, if I look at my PMS, we for the past 6 months, we thought there could be volatility. So did we go into cash? No, we just hedged. So we bought insurance in a sense, and which was good. If we had gone into cash, we would have missed out the entire move from March to now. So insurance has a cost, but better to pay that 1% cost rather than put 20% in cash and then find the market has gone up and you were left behind.
So wonderfully, Devina has just described what the situation is, and she still doesn't think that the entire market is like, right up there from where you should be scared. But there are pockets in the market that are frothy, because if someone is starting today, considering the backdrop that the picture that she has painted, what is it that you would tell people they should do? There's this concept of asset allocation. I mean, if somebody has managed to successfully save money and they have money to invest, if they are starting today, what should they do?
Uh, you see, the concept of asset allocation actually has been very well promoted, talked about. But I think the essence of asset allocation is not the asset allocation itself, but the discipline behind the asset allocation. Too often we realize people, and this is across all investor levels, whether it's an individual, family office, corporate treasury, there is always a tendency to skew towards, a particular asset class just because you're getting better than optimal returns there. So I think the point about asset allocation is that you need to sit down with an advisor and make sure you have a good advisor who stops you from going overboard. I think that is the first part. What would I advise people to do? I think to just pick up a thread from what Devina was mentioning. If you come out of equity, where will you go? This is probably the world's most exciting equity market at this point. I think it's time now to start looking at factors. For the uninitiated, there are factors like value, momentum, quality, size, and I would urge you to just look at it. But what has happened is, and this is again to quote data, every time the world comes out of a global crisis, typically there's a gush of liquidity which comes in, and value starts doing very, very well. So you look at 2000, you look at 2007, 8, you look at 2020, 2 to 2.5 years, you will find value doing very, very well. And then quality makes a comeback till the next crisis. So what is happening right now is there's quite a bit of froth in the value stocks. And I think you alluded to that in terms of certain thematic stocks. And this is typically what happens. But quality, companies which are growing year on year, steady cash flows, good dividends, low leverage, I think they've been unrecognized, under-recognized, underperforming for the last 2 to 3 years. So it would be a good idea to actually start looking at that, okay? And last but not the least, people still insist that, I think I'm very worried about equity, markets will crack, and I think this happens every time. Famous last words like this. And in this country, I think everybody is either a cricketer or a Bollywood commentator or a stock market expert, right? Yeah. So you really can't fight that. But if you do want to get out of equity, okay, I think the options at this point of time, and again, as per your asset allocation, could be gold. Gold is a very effective hedge or reasonably effective hedge. Could be some parts of fixed income. Definitely not cash. I think this is a country to stay invested in despite what the volatility is happening at this point of time.
Right.
I'd like to just add some things on asset allocation, especially since this is not an audience of investors per se. Asset allocation means that you must know how, and before doing asset allocation, you must know, as I always say, in Google Maps, you don't just put the destination, you also have to put the starting point. So know where your asset allocation is. So what is asset allocation? You have an equity bucket, which is stocks that you own as well as equity mutual funds. You have a fixed income bucket, which is fixed deposits as well as fixed income mutual funds. Then you have gold or silver, you have real estate. So first know where all of this is. Then depending on what your horizon is, what your goals are, you decide where you want to invest, because this is also, if you're not a professional investor, this should also, sort of calm you down, that most of your returns, 85-90% of your returns come from asset allocation, not from finding that one stock which your friend was talking about in the party. So get this right. Whatever you put in equity should be money you don't need to look at for at least 5-6 years. Don't put something you will need after next year or the year after in equity. However young you are, never put 100% in equity, because you don't know what might come up. That might be a medical emergency. You might want to pay down payment on a house. You might to go abroad for studies. You might lose a job. So have some in other asset classes. And one thing which Indians often forget, that India is not the world in equity markets. India is only about 4% of the world equity markets. And when we talk of asset allocation, you cannot forget the globe. And the globe is not the US either. So you must look at global assets as part of your asset allocation. If you think you can ignore it, let me just give you one number. When I started working, the dollar was 12 rupees. Now it's 83.5. That is a 85% depreciation in less than a career. When you're talking long-term planning, you cannot forget the globe. When I started working, there was no option to invest globally. So our grandmothers were not wrong to buy gold, because that was the only way to hedge the currency. Now you have many options. So do invest globally. And as a firm, we believe in that, and that's why we have a fully global product that starts at $10,000, 8.5 lakh rupees. Normally, you will not get a global product for less than $1 million, which invests across the globe. So, but this is a cause for me. Over time, have at least 30% of your assets which are global, not India.
There is that thumb rule, right, where your age minus equity. I mean, what is that thumb rule? That 100 minus your age is your allocation to equity, right? Does that really work? I mean, these kind of thumb rules that are there in the
And
market.
not really speaking, because if you are, let's say, you are a 35-year-old unmarried person with no children, no liabilities, and also what your bucket list is, what you want to do in your life. So ultimately, it has to be according to your goals that you have, or is it that like 7 years later you have to send a child to college and who wants to study abroad. So, all those factors have to come into play. But as I said, however young you are and however stable your job is, because I get these kind of questions sometimes on social media, don't put 100% in equity. So always have money which is available.
Besides, people are living longer.
Yes.
The original thing was that 70 is your average age. Nowadays, you have 80, 90 is so I
Right.
think asset allocation from that thumb rule point of view, I think it would work.
So you mentioned about financial advice, and I'm going to then just pick that thread along, and just dwell on that for a bit. When we start investing, our first advisor is probably some uncle in our house, or your for us, I think it was our LIC agent in our company who kind of made us start investing, many years ago. So how do you recognize a good financial advisor? What are the traits of a good financial advisor? And how do we choose somebody who is not an uncle or aunt?
It sounds like a very simple question, but there is no simple answer to this. But I'll give you two points of view. I think if anybody's seen this movie, The Wolf of Wall Street, there is this dialogue which I think Leonardo DiCaprio says, "Don't judge me by my winners, judge me by my losers." Okay, so typically a financial advisor should be one who's seen a few cycles. Very rarely will you see somebody very young of age having that perspective in terms of a very mature outlook. So the more cycles some financial advisor sees, it's better. I think from that point of view. Sorry, I just lost my train of thought. I was just thinking of a grandmother as the first financial advisor when she talked about it.
When you said somebody who's seen the cycles, I said it's the uncle who has seen the cycles, theoretically speaking.
Uncle would
I
have
just
seen.
stopped myself.
Yeah, but these uncles are very dangerous because they're not certified. And then they will come to you with the next shiny thing. And I've seen most uncles actually talk about insurance,
Yeah.
because that's the most remunerative one, which again brings to the light the aspect of mis-selling. But yeah, typically financial advice should be somebody who's seen a lot of cycles. And I think as a country, one of the things I'm seeing happening very rapidly, I share pretty much the same vintage as Devina. And I think one of the things we've seen change over the last 20, 30 years is that people are moving from a mindset of scarcity to a mindset of abundance. Okay. Earlier, it used to be you don't know where your next meal is going to come from. You need to save, save, save. So you used to have, money in rice jars and all of that happening. But I think over a period of time, there is a lot more comfort. There's a lot of more comfort with the way you are as a country, the way you are as a generation. And I think most of us have provided for the next generation. So now this generation wants to experience, wants to see the world, wants to save the planet, wants to do a lot of things because they don't need to worry about setting up a house. Okay. And I think any good financial advisor who comes in has to recognize this, because quite a few times I've seen financial advisors trying to straitjacket, whatever they are saying in terms of a particular thing which they've learned. Like you mentioned, rule of thumb, you know. So I think a good financial advisor is one who will listen to you, who will customize plans according to what you think is necessary, and of course then makes you stick to it.
Right.
Yeah, I'd like to add to that. Of course, you're right, which is precisely what I was also saying, that even the person at the same age may have very different requirements as to what they want to do, but I would say in order to choose an investment, and in fact even an investment advisor, basic financial literacy is very important. So there is no way around it that you must be able to understand basic numbers. And I think this should be part of the school curriculum. Maybe we should have said it when Aditya was there, that that we need to really incorporate that, because at the very least you must know how to calculate the internal rate of return, IRR, because otherwise what happens is that you are sold an insurance product as an investment product. You don't realize that how much of your first year money that you give in is just given to the advisor or whoever, to the intermediary. And therefore, instead of starting with 100 rupees, you're actually starting with maybe 80 or even less than that. So unless you can calculate that number, anyone can just show you, okay, this is the kind of return you'll make, and sign here. So be able to at least understand the basics. You don't have to understand nuances of every stock on the market, but at least know financial basics, because otherwise you will not be able to judge who is telling you something. And if possible, of course, always this is a problem. It's called the agency problem, that the person telling you the advice has a different payoff from you. So they will advise according to what gives them the highest fees or the highest cut. So this is an issue. If possible, you should know how much cut that person is getting, which is not always possible, but at least you can find out what you are likely to get and be able to calculate that.
Aren't they supposed to disclose whether they are getting remunerated by the
Yeah, so
product?
I mean, but most people will not even ask. They will not know to ask. That's why I'm saying that if to whatever extent you can find out how much they are getting compensated and which product is more lucrative for them, which may not be more lucrative for you. And this was mentioned, mis-selling. So mis-selling is at many levels. So this is like, you will find a retiree going to the bank with their PF and being sold an insurance product there, because that makes money for the banking relationship manager. So just because somebody looks nice and comfortable doesn't mean that they'll necessarily give you the right advice. Even to an extent, I would say most thematic funds in the market are mis-selling, not in a deliberate sense, but the fund manager well knows that this theme has really run most of its course and it will not make money for the investors, but it will gather assets for them, it will make fees for them, and that's why that new fund offering comes up. So those things you have to keep in mind. So you will have to educate yourself at least to an extent in order to even judge who's telling you the right thing.
You wanted to add something to it?
No, I was listening to her, and I think I agreed to one point, is that what is more dangerous than illiteracy is financial illiteracy. Okay, in illiteracy, you may not be able to read or write, but in financial literacy, you might lose your shirt. And that is a clear and present danger all the while. But what is equally important to know is, the regulatory landscape has completely changed. For example, if you talk about mutual funds, or even if you talk about alternate investment funds, PMSs, one of the key drivers used to be a certain portion of the commission which the agent used to get upfront. Okay, now everything is basis the duration. So whatever you make as an advisor will be to the duration the investor stays. Okay, so that is one. Second thing is that certifications are now mandatory. Certifications are mandatory for the sales teams. Certifications are mandatory now for investment teams. Certifications are mandatory for even principal officers, who are supposed to be the conscience keepers of all of this. Also, what is happening is, in certain products, in fact, almost in all products, once the investor buys the product or subscribes to the product, there is a call which happens from the asset management company saying that, you recently bought this. This is just to tell you that this is the product and this is the risk attached to it. And this is all on a recorded line. Now, this does not eliminate the specter of mis-selling.
Right.
Okay, that is for sure, because somebody who wants to mis-sell will find a way to mis-sell despite whatever you want to do. But I think what needs to be appreciated is the intent of the regulator. They have kept the investor as the center of the universe and said we will do whatever it takes, to ring fence him from whatever is possible.
Now that you mentioned the regulator, there have been certain actions that SEBI has taken, the market regulator, in reaction to what has been happening. One is about financial advice. I mean, they are going after those quack financial advisors, and they are kind of trying to bar them from giving any professional advice, but there's also a reaction from SEBI on the hyperactivity that is happening in the options category, for example. There was an intervention on that front as well. Then there was also this thing from SEBI about the third thing, which I was just about to talk about, the IPO. SEBI cautioned everybody about the IPO market as well, and also encouraged mutual funds to restrict flows to small and mid-cap companies as a reaction to what was going on in the market. Now, does that, you both who have spent such a long time in the markets, do you think our regulatory system is equipped enough to protect people who are not so familiar with the market? I mean, are you comfortable with what is happening on the regulatory front?
I think our regulators are pretty much equipped. I mean, they have access to all that the world has to offer. What is happening in the markets, of course, in India, in the derivatives and futures and options and all that is completely off the charts in terms of how the rest of the world behaves. So the numbers are just crazy, and people think it is an online gambling or lottery, and no matter how much data is shown that nobody makes money in them, 90% of the people don't make money, that's one. But even people who make money, how much money do they make? They make 50, 60,000 rupees a year. So, it's not as if that they are blowing out the lights. But, one of the areas which I like to read about a lot is the issues in human thinking, in your own, how much your brain tricks you. And one of the key things which human beings are particularly bad is understanding probability. So going into something that the probability of making money in this is in single digits, but you only look at that one person supposedly has made so much, and I will be that one person who will make that much. You are unable to understand, and this is a known phenomena that human beings just look at the size of the payoffs and they cannot understand the probability is so low, and therefore they should not be playing this game. So to some extent, the regulator has to change, as they did, that make it little less lucrative for at least the intermediaries to push this volume, because a lot of it, the volumes have come from push, and also because the customer was still paying the same brokerage on every transaction, whereas the intermediary was making more money as the volumes went up, because they were getting a discounted rate from the stock exchanges, just to put it simply, and therefore at least that loophole has been plugged. But ultimately, you cannot put the blame entirely on regulators when things go wrong. And if you read, there's a very short book called, a very beautifully written book by John Kenneth Galbraith, A Short History of Financial Euphoria. It's like you can read it in a day. And but it talks about the pattern of bubbles, and of course it also says that financial markets forget history. I mean, that's the characteristic of financial markets, that they forget history. But one of the key things is that when the bubble burst comes, everybody looks for villains. So, some companies, some banks, some brokerages will be basically hung out saying that they were the villains. But actually, the people speculating are also responsible for their losses. But no one at the end says that, they were at fault. Like just as in that crypto and NFT burst after 2021, it was that who are the villains? But you who were out to make a quick buck were also responsible. So, that is something you have to recognize, that the person who's trying to be too greedy, and I mean, nowadays people come and say, if you promise less than 30% equity returns every year, then you don't know your job, then you will go to somebody who's promising you 30%, and you don't know when it will become negative 30% or negative 50%. So.
You have a view on that?
But if we, I was thinking here, if we stop looking for the villain, then we will be out of business.
That's why I tell people that don't spend too much time on what media tells you on why the market moved in such fashion yesterday, because they have to fill the pages, they have to fill the hours. You don't have to.
So I'm just now going to come to the point that, again, from where we started about today's prices,
Right.
that are a functioning of tomorrow's profits, right? So a lot of things that are priced into today's prices is like, one of the thing is price stability, and probably people believe that prospects are really good. There is an India story that is playing, and there is a lot of profitability that Indian companies would have in the future, for which they are giving them such higher prices today. What could go wrong with the India story, in your view? I mean,
Okay, I have never been an advocate of the India growth story, because for the last 30 years, you hear the same. I mean, today also I saw a table somewhere saying penetration of ACs in India is so much, in US it is so much, China it is so much, cars, etc., etc. The same kind of data I've seen for 30 odd years. So there are always penetration in India of anything is low. And if you look at, see, markets and economy are two different animals. And in the economy, I see a lot of areas for concern. So all that Vikas, for example, was talking about that, now people have taken care of all their basics, and now they are looking at great experiences, etc., etc. We are looking at only people like us. If you look at the data, the very fact that 80 crore Indians need free rations tells you where the bulk of the country is. I was reading this book by Rama Bijapurkar called Lilliput Land, and it was an eye-opener for me that it is not just that in relative terms the poorer people have lost out. She had done this graph of quintiles, so top 20%, next 20%, next 20%, like that. And since 2016, for the bottom 60% of Indians, their incomes have actually gone down. It is not on a relative terms, it's actually gone down. And also for the bottom 60%, their income minus their routine expenditure, not including medical or marriage or something, is already negative. So they have negative savings. So that is the truth. Also, we talk of the demographic dividend. Now, the demographic dividend is actually a product of three things if you go into study of demographics. First is the percentage of people in the working population, which of course is good for India because we have a lot of young people. But that has to be multiplied by the number of people who have a job into the productivity. So we are faltering on the second factor. We are not finding jobs for the youth. So those are the issues. But if you look at the listed space, many of the listed companies, for one, after demonetization and COVID, a lot of the small and medium scale enterprises went out of business. So businesses became more organized, which helps the listed companies. Also, in many businesses, the listed companies target the more affluent customer. If you look at, for example, listed real estate companies, they build houses for the affluent. So that's how, I sometimes see people on TV saying, oh, things are going so well. All my friends have bought houses. They have bought new luxury cars and SUVs. But, even if you look at cars, and the luxury cars and SUVs are selling much more than the entry-level cars. So again, every level you see that difference between the affluent and not so affluent customer. But it is helpful for the listed companies in terms of earnings. There is one particular thing which will help earnings, I think, this year, which is that food prices are coming down because the monsoon has been good. Crude prices are down, and a lot of inputs are related to crude and downstream of crude. So for
we're talking about what can go wrong. That is more positive.
But then I'm saying that the economy, there are a lot of things that are question marks. So I'm not saying that the economy, I'm not like that. And also that, people also ask me this question, since you talked about the growth, that if India is the best growing economy in the world, why should I look elsewhere? And in the 90s, the fastest growing economies in the world were the Asian tigers, which is all this South Korea, Taiwan, Philippines, Thailand, etc. And then came one fine year in the late 90s when in 1 year all those markets were down between 50 to 90% between the markets and the currency. So I mean, those are all risks. So, but as I said, I'm not saying that any disaster is awaiting India, but I'm saying on the economy side, there are many question marks. So it's like not, again, see, but there are a lot of times people have, because they have to keep selling the India growth story in order to say that please invest in my fund. But you have to take a more nuanced, more balanced approach as to what's actually going on.
We have to move to the questions. So
I'll just
your
probably
brief thoughts on
yeah,
what
she's
can go
already
wrong
what
with the
can
India
go
story.
wrong. I think in 2007 beginning, if my memory serves me right, Goldman Sachs had taken all their senior executives to a retreat, and they were trying to gauge what were the risks in the system which they should be aware of. Almost everybody said they don't see any perceptible risk. Okay, and then 2008 happened. Yeah, so I think this is something which in today's context you'll have to really think hard what can go wrong, and things will go wrong. I think one of the things which I personally am monitoring is the inflation rate. Okay, she did mention about the income coming down in real terms, and despite the fact that today you have basic level of insurance and all of that stuff which is happening, people are little bit more financially savvy. And I'm talking now almost going down to the bottom of the pyramid, wherever people can invest. The fact remains that you need to be worried about inflation. It will just take money out of your hands. It will make you react in ways that you did not think would be possible before. The second thing I think is from a corporate point of view, corporates and markets. I think the markets have pretty much finely priced in terms of what most corporates can deliver. And I think anything in terms of earnings shortage or earnings disappointment might affect the markets, and it begs the question what might lead to earnings disappointments. I think the answer which you can look at is around you. I think the geopolitical risk is very, very high in the system right now. We may choose to close our eyes and think that India is going to be, excused from all of this, but sooner than later it will affect, whether it's in terms of trade lines, crude, all of that thing. And again, it'll kickstart your inflation process, and it's a vicious circle. You don't want to go there, which is what is something which worries me.
So I guess from what the two learned guests have told us, I think they have given us a nice picture of where things stand right now, what could possibly are the pitfalls that are going to be lying ahead, and they also spoke about what could go wrong with the India story. Now let's throw the floor open for a few questions. If you have anything on investing, money, personal finance.
Hi, good evening. My name is Shomit. I'm a financial planner. My question is to both of you. First, regarding the NFO. Now we see a string of NFOs on the manufacturing theme coming up. This has kick-started prior to election when one of the AMCs launched their manufacturing fund, which was followed by the finance minister's speech that manufacturing is the next sector because it will solve a lot of India's structural problems like employment, job, and all those things. So if everybody is coming with the manufacturing theme, though the manufacturing index have given a 70% return in the last 1 year index, there are matured funds which has given more, but there's a beeline of new manufacturing fund NFOs which are coming up. So an investor who's putting money in every manufacturing fund NFO, what does the prospect for the investor is there? The next question is regarding the valuation and pricing. Now markets are at a very, very high level, but we are very bullish that there are pockets where there are a lot of structure, like scope of growth. So which are the sectors which in terms of valuation and price looks attractive to put money in, because what is important and what price we are getting in? So these are my two questions.
You want to go first? Okay. So first on the manufacturing, so as I said, most of the time when there's a cluster of thematic funds, they come near the peak of the cycle. So I'm not saying that manufacturing cycle is over, but definitely is fairly mature. So I will tell you, manufacturing, which is, if you look at industrial machinery and capital goods, now that's a sector most people started talking about in the last year or a little over that. We have been overweight that sector for 3 years. So October 2021 is when we went overweight in that sector in our PMS. And the question we ask every quarter is, that is the story over? So definitely, you know, many stocks went up 2 times, 4 times. We've been booking profits, and over time we've cut down to when we are now very close to the benchmark weight. We are just little over that. So I would say most of that story has peaked out, or not. Even if it's not peaked out, a lot of that story is behind you. So you are somewhere in the high level. Now see, one thing is that thematic funds come near the peak of that theme. That's one point. The other point is, as I said, most of your returns come from asset allocation, and within equities, they come from that should I be in small cap or large cap just now, or like what was spoken about in terms of value versus growth. Should I be in value or should I be in growth? Should I be in pharma or should I be in IT today? So once that question is, that's where most of the value addition is. So if I'm leaving that to the investor, to the person on the street who has no better information, then what value am I adding? So that's why, like for instance, we never have anything other than a pure equity and a pure multi-asset product, because we think that's where the main value addition comes, that should I be in this industrial machinery or should I be in banks? If I'm leaving that decision to you, that right now I should get into manufacturing and I should get out of manufacturing after 6 months, then what value am I adding? That's one point. In terms of sectors that we like, now, you know, we do a base zero rebalancing again to get out of the bias, and we do it based on an artificial intelligence machine learning system. That's another story. And of course, it's not a black box system, but it does a lot of the heavy crunching for us. But last change which we made, we are quite overweight pharmaceutical and healthcare. We are quite overweight auto components. We are slightly overweight industrial machinery still. Last time we went little overweight IT. We've added some chemical stocks. So that's broadly where we are overweight. We are underweight banks, utilities, all this defense, energy, that kind of thing. So that's broadly, but you know, that changes because we look at everything afresh every quarter. So what I tell you today may not hold for 6 months or more. Some of it will, some of it won't. So, but that's where we are currently positioned on your sectoral question.
I'll start with the second question first. Sectoral, I think it's a very nuanced answer. I'll just add consumption to it. I think consumption is one, and pockets of consumption, I think, can still be bought. On your first question in terms of NFOs, look, I think, like she mentioned, at the peak of every market, 2000 it was IT, 2007 it was infrastructure and energy, and now it is defense, PSUs. There is a demand and supply equation out there. That whether you have too many manufacturing or thematic NFOs is not the question, because a sensible financial advisor will step in and say, listen, you did not do that. The question one has to look at is how much of fresh money is coming into the NFOs. I think most of the money, or quite a bit chunk of money, is coming in from other mutual fund investments in the same fund house to this. I think SEBI had come up with a paper also on that. There are a lot of investments are moving from one fund to the other. And why it is not a very healthy practice, if indeed that is rampant, is because I think 10 odd years ago, we had done a survey that an investor who enters through equity usually enters at the peak. His average stay in a mutual fund horizon is 7 years. But if he comes in through a non-equity source, it could be debt, it could be gold, it's usually 12 years. So the experience of coming into a thematic fund when there is a lot of rush of liquidity and it's the next shiny thing might not pan out to be good, at least for some time. The third point, which is the most interesting point, is most people who are actually recommending NFOs, if at all, are recommending these NFOs in SIPs, not lump sums. Now to me, that's a sign of maturity. That's the sign that this whole mutual fund Sahi Hai campaign, and it happened when I was on the Amphi board, this whole thing is starting to play out. People want to take exposure, rightly or wrongly, but they are hedging it, quote unquote, from a point of view of getting into SIPs. So to answer your question, how many new investors are coming in with fresh money? That is the crux which we need to look at rather than just the thematic NFOs. Two is the fact that, SIPs, I think this is what one needs to think. And the third thing is in terms of mutual fund Sahi Hai campaign and how how nuanced they're making the entire investor perception. I think at the end of the day, it all boils down to a financial advisor, which is the first question you are asked.
But there's also this thing that about SIP investors. I mean, there was a survey
Yeah,
by
yeah.
AMFI.
What is the net versus gross and all of that?
They don't stay
Yeah, I mean,
long for
the
long.
data is that half the mutual fund investors don't stay even 2 years.
No, but that is lump sum. If you're talking about SIP, I'll tell you what is happening. If you dig deep into the data, because you have to really find, work on a conclusion and see whether data substantiates that. What is happening is people who had invested a long, long time ago are seeing a substantial rise in their SIP holdings. Okay, so that is where they're stopping. Rightly or wrongly is a different question. Quite a lot of people are booking profits at this point of time, and they're stopping the SIPs. They're taking money off the table. That's what I hear, from the industry at this point of time. So I think that is probably a more granular version of SIP stopping.
I mean, on thematic funds, I'll just give you an anecdote. So somebody on Twitter wrote to me saying, ma'am, you keep talking against thematic funds, but look at, I won't name the fund house, but look at this tech fund, and it was 2 rupees in 2003, and this in 2023, in 20 years, it has given X returns. I said, very good. It was 2 rupees in 2003. Did you see when it was launched? It was time to perfection. It closed 1 week before the global tech crash. So मैंने कहा वो 2.5 साल में 10 का 2 रुपया हुआ ना. फिर then you are telling me कि 2 रुपए से इतना compounding हुआ है ना. That's not the point. That's the whole point, that the NFOs come at the peak. There might be a time to buy that thematic fund, but that's usually not the NFO time.
Any other
Yeah,
questions?
good evening. I'm Harish Das. I'm a retired media professional from an advertising agency. I address this question to both you speakers. In this tech-driven world and survival in the rat race, do you mean to say the traditional investor of banks, post office, and all those things is going to die down with the... I mean, I don't understand anything of the present day SIPs and all IPOs, nothing. But do you mean to say they will be totally obsolete? They will no longer survive the traditional investors?
I would like to say, as I said, in the asset allocation, you should not put 100% in equity. So you should put something in that fixed income, which is all those postal savings or whatever. I don't know the tax implications of each of the traditional schemes, but basically you should have something in fixed deposits or some kind of saving schemes and so on, and not put 100% in equity. So it's not as if that you should not look at that side at all, but that should not also be the bulk of your savings, especially when you are young and you have to, because compounding is important. Many of those assets don't give you much more than the inflation rate, if at all up to the inflation rate also. So as I said, don't be at either end of the risk spectrum, because when you take nearly zero risk, then you get no compounding if you want to build up a corpus up to retirement. And on the other hand, don't say that I will become a day trader or a crypto trader or this and that either. So be somewhere in the middle, take a balanced approach.
Yeah, I thank you. I just, like you said, the dollar rate, when I also understood, it was 16 rupees then. I do understand, but I still get afraid of this type of investments. I don't know whether it's unconfounded fear.
So, yeah, I think it is all got to do with what you're investing for. Okay, is it a near-term requirement? Is it a long-term requirement? Because typically in a long-term requirement, which is 3-5 years plus, willy-nilly a fixed income investment will not work. It's probably an equity or a hybrid fund which will really do well for you. Second thing, sir, is I think I started off by saying initially about this mindset of scarcity versus mindset of abundance. What I also meant from that point of view is adapting and evolving. I think it's been 30 years since mutual funds have been launched in this country. And the growth has happened primarily because people have seen a lot of value in the mutual fund segment. And these are not necessarily either debt or equity. There are several alternatives available. What I would recommend is you get a good financial advisor who will sit down with you, who will map your requirements, who will map your cash flows. To my mind, more and more retired people are getting into long-term equity. You know, it might seem like a paradoxical statement here, but this is actually a fact. The general belief is that whatever your work life is, that is the time of, that is going to be the time you're going to spend after retirement also. So you need capital growth. You need to create wealth for yourself and not necessarily depend on conventional, quote unquote, high yielding investment opportunities. So that's what
Your
it is.
point on longevity is actually very right. I mean, my mother has been a pensioner longer than she worked. So,
How do you allocate the ratios of allocation? How do you ratio it up in this scenario?
In this scenario, yeah. And then please go ahead. Please go ahead.
so I mean, it again, as Vikas said, it depends on what your horizon is and when you require the funds, what your goals are. So,
If you are talking about like 10 years horizon, so what will be the ratio bifurcation?
10 years is not very long also. So, eventually you may not require all your funds after 10 years. So that's why you have to go through that exercise, that when will you require each tranche of funds roughly. I mean, it may not be exact, but my child will go for college at this stage. I will retire at this stage. So this is where I will need the monies, and then you will have to balance it accordingly.
I would advocate if it is 10 years, depending, again, irrespective whatever age you are, you might be 70, but if you can afford to put in patient capital for 10 years, then you should allocate some money to equity. You should not stay away from equity completely because
Yeah,
equity in
that
its various
definitely.
forms is going to give you that sort of wealth creation. Equity hybrid, equity blended, whatever you want to call it.
I would say even at 10 years, you should have majority to equity, but not 100% to
I
equity.
agree with that. There's an anecdote I thought I'll just share. It just struck me. Way back in the day, when we were talking about mutual funds, and we could not even say AMC. Rather, we could not even say mutual fund. We had to say AMC because there were a bunch of PSU funds and an international fund which had spoiled the market for mutual funds. So I remember having spoken to this. I think he must have been 85, 90 at that point of time, and I'd gone to him. And I said, sir, you have such a lot of equity in your portfolio, and I think more than half are not even performing. What are you doing? They become penny stocks. Please sell them. Now, this is investor psychology, okay? So he listened to me, Raven ran for 5-10 minutes, and he says, okay, how old are you? So I said, I'm 35. बोलता है बेटा आपकी जितनी उम्र नहीं है ना उतना मैंने मार्केट में टाइम गुजारा है. एक चीज़ याद रखना, बंद घड़ी दिन में 2 बार सही टाइम दिखाती है, इसका भी टाइम आएगा. Now, if that is the mindset, you really cannot fight it.
No, but that
really,
doesn't mean that's a right
No,
mindset.
I'm not. I'm saying you can't fight it because people come with different mindsets. At that age, if you're still talking about holding on, obviously he had a lot of patient capital with him. But I'm saying to each his own. But as a rule of thumb, you should have equity in your portfolio.
That depends again on, as I said, what your goals are, how much do you require, when do you exactly require it. But so we can't give you a number which will be for everybody.
So ballpark, if you see $2,000 per capita income is the level through which a country starts getting into a prosperous mode. If it's less than 2,000 per capita income, typically it's been found that 30 to 35% is in equity on an average. So you're including all sorts of people there. The moment it crosses $2,000 per capita income, it starts inching forward. I think most companies, most countries who cross $2,000 per capita income, the share of equity starts rising dramatically. So 4-5 years after that, you'll find 60-65% in equity, simply because the basic needs are taken care of. They don't need to, keep spending that money.
Anyway, I think we are absolutely running out of time, so we should just thank you very much, both of you, for sharing your wonderful knowledge and thoughts with our audience. And Gurbir,